Hey, what's up guys, John here. We're walking into the biggest crisis in American history. Everyone looks back to 2008 as if it was the great financial crisis that rocked the world.
So I think this is the most significant financial crisis in the post-war period.
Soaring gas prices, falling home prices, and rising unemployment.
But what if I were to tell you that home prices have doubled since 2008?
A surge in home prices is pushing housing affordability closer to historic lows.
Home prices are rising nationwide as inflation remains stubborn and mortgage rates remain high.
Monthly payments on these homes have doubled since 2008, but yet wages have remained relatively flat. We look at what's going on with car payments. We look at what's happening now with lending. Many American businesses are leaning on credit cards to make bills. And these credit card interest rates are 30%, 32%. We're walking into something massive and big banks know it. They've closed 3,000 bank branches in the last 12 months, firing 100,000 employees. We're walking into something that's going to rewrite American history. I'm going to break it down for you in this video. Please hit the like button. When you hit the like button, YouTube will share this content, educate more people about what's really going on. And if you'd like to fix your credit to position yourself for this wealth transfer, we'd love to help you on my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any negative item on your credit report, go to GreatCreditFast.com. Click the link in the description below this video. Schedule a free strategy session. Take a look at this. So, in 2008, 2007, 2008, consumer credit card debt was about $320 billion, right? $320 billion. Now it's approaching $1.1 trillion. Probably by the end of the year, after holiday spending, we're going to start seeing this number hit closer to $1.1 trillion. So we're going to see a 300% increase, roughly, on credit card debt since the great financial crisis. We look at how much homes were back then. The average home in America, $257,400, right? The average interest rate back then, 6.4%. So $257,400, 5% down, that interest rate, $2,200 a month, $2,200 a month. How much have wages risen? Well, not much. Wages are relatively flat, right? So wages are relatively flat. Yet today, home prices are $410,000, and mortgage rates for the average credit score in America, which is a 698, is 8.328%. So just for context, $410,000 home, 5% down, so the same down payment that we put here in this example, with 8.3%, monthly payment $4,000. $4,000. Now, some people might say, John, we can get a better interest rate. We could probably get 8% or 8.1%, maybe, but for this example, I've left home insurance at only $100 a month. Where are you going to get home insurance for $100 a month? You're nowhere, right? Home insurance now, we've been looking at $3,000, $3,500, $4,000, depending on your market. So $4,000 a month is what people will be looking at for a mortgage payment today. In New York, to rent a place in Manhattan was $1,100 back during the great financial crisis. $1,112. You could rent in Queens for $790. I mean, this is absolutely crazy. The average car payment on a new car today is $740. So the price of a car payment today is what it was to rent in Queens back then, right? You could go to Brooklyn for $698 or the Bronx for $674 a month. Like this is where we are right now. People are financing groceries. They're financing groceries. So when they say, hey, we're going to have a soft landing, where is this going to happen? Because consumers are getting pushed off of a financial cliff right now. That's what's happening. And banks, they know this. Like banks know this. They're looking at these outstanding credit card balances and they're seeing how much pain consumers are in. Jamie Dimon, he's a CEO of JPMorgan Chase. He's committed to selling $141 million of his own stock, his own company stock, and he's came out saying, yep, the excess savings amassed by low-income consumers are gone. Consumers are broke. So if they're broke, how are they going to pay back their loans, these $700 car payments? How are they going to pay their credit cards? How are they going to pay their business loans, their mortgages? They're not. They're not going to be able to. So why is he selling? Because he knows that banks are in trouble. He knows the economy is in very big trouble. JPMorgan Chase CEO Jamie Dimon sees a divergence between the two ends of his customer base, with lower income consumers running out of cash cushion that they amassed during the pandemic. They don't have excess savings anymore. Jamie Dimon, right? Executives from other banks view it in the same way, noting that lower income consumers are feeling more pain on several fronts. Wells Fargo CEO of consumer lending called it the tale of two cities on Thursday, middle and upper class customers are performing quite well, while there are signs of stress among those lower income. They probably deem lower income today $60,000, $70,000, right? That's probably what they view as lower income. Nowadays, making $100,000 a year, that's viewed as, you can't really even live in an expensive city and not be in credit card debt making $100,000 a year. Average rent in, Los Angeles, you're looking at over $3,000 a month. If you were to rent in Manhattan, it's about $5,000 a month, right? So the definition of lower income, the definition of upper income today has changed dramatically. I mean, we're walking into this wealth transfer. The middle class is getting absolutely eroded. It's getting absolutely eroded. That's where the deterioration is mostly. As a result, he said, Wells Fargo is becoming more conservative on extending loans to that income segment and not originating subprime loans anywhere. Any asset class, nothing. And I've been warning about this, saying credit scores, all this stuff, it's going to be so important in the next couple of years. It wasn't that important in 2021, 2022. Everyone can get a loan. Like, you basically just sign on the dotted line, you can get a loan for 2, 3, 4% interest rate. It didn't really matter. But now banks are looking at the writing on the wall that consumers are in really, really big trouble, and they want to cut as much risk out of the equation as possible. Personal savings as percentage of disposable income in the U.S. from 2015 to August 2023. Look at this. All that money pumped into the system, everyone used it to buy cars. Everyone used it to, invest in crypto and stocks and do all these different things. And now, boom, inflation took over, job market softening, consumers are in trouble. That's what's happening right now. Small businesses, right? They say right here that inflation interest rates on creating unique challenges for small businesses. The study said small businesses are feeling the strain, increasingly reliant on credit cards. Federal Reserve has raised interest rates sharply over the past year, approving 11 rate increases in the hopes of cushioning inflation and cooling the economy. In the span of just 16 months, interest rates have surged from near zero to 5.25 to 5.5. This is a Fed funds rate. So this number is going to likely 7%, according to Jamie Dimon, meaning mortgage rates are probably going to go closer to 10%, meaning credit card interest rates that are already near 30% are going a lot higher. So we're going to walk into a situation where consumers are just going to stop paying. They're going to prioritize food over paying back their creditors. Hiking interest rates tends to create higher rates on consumers and business loans, which then slows the economy by forcing employers to cut back on spending and hiring. The Intuit report suggests that higher interest rates are disproportionately affecting small businesses because those firms are particularly relying on credit cards' credit availability in order to function. And net 4% of small business owners reported their last loan was harder to get than compared with the previous 3 months, according to the recent survey published by the National Federation of Independent Businesses, a Tennessee-based association of small businesses. Another 24% reported paying a higher rate on their most recent loan. Small businesses are feeling the challenge of tighter monetary policies, particularly when it came to securing loans, which have become both scarcer and more costly. So you're seeing what's going on here. You're looking just in 2007, 2008, look at how much car loan demand has increased dramatically. Look at how much interest rates have changed on cars in just the last, call it 24 months, the last 2 years. So this is crazy. This is absolutely crazy. But now, they try to pretend like we're going to have this, easy, soft landing on the real estate market. 18% of homes listed in September had a price reduction. 18%, right? I mean, you look at this lady listed her home for $650,000. She went under contract for $400,000. And she also had to credit $7,000 to the buyer, probably things that came up during inspections. But you start to look at this, you're seeing a completely different type of housing market that's being formed right now. And what I think is going to happen is we are going to start to see something shocking come January, February, because these student loans that became due October 1st are becoming very, very interesting. Because look, they're saying a quarter of student loan borrowers said that they're going to boycott these payments. A quarter. So you think about this. There's 43.5 million borrowers. You're looking at, let's just call it 10 million borrowers that are not going to pay. January 1st, it's going to go on their credit report. So as it goes on their credit report, their credit scores are going to sink. And when they sink, it's going to put a lot of pressure on these consumers to be able to they're not going to be able to get credit as easy. They're not going to be able to get loans as easily. So what's going to happen? Many of these college-educated Americans have homes, And these homes have insurance premiums that are going up, taxes are going up, utilities are going up. The economy, the labor market is softening. So what's going to happen? People are going to be pushed to sell off assets. We're walking into a situation where all consumers are in a lot of trouble and a lot of people are going to have a harder time getting loans. But if you look at what the smart money is doing, the deep pockets, the big private equity firms, the large institutional investors are sitting on mountains of cash. They're not buying right now because they know consumers are going to be forced to panic sell most of their wealth that's formed in these assets. And they want to sit tight. They want to sit tight. They want to watch this show that's about to take place. So if you're thinking about investing in real estate, you're thinking about starting a business, growing a business, now is the time to stack cash. Now is the time to make sure that you have a really, really good game plan. You know where you're going to invest. You have money coming in. You have great credit. You're putting yourself in a position. You're not a subprime borrower. If you are right now, you need to change that to put yourself in a position to where if you were a bank, you would want to lend you money. That's how you need to look at it. So you can go out there and invest, because you think about it. When these institutional investors are buying up everything in America over the coming few years, do you think they're going to keep rents cheap? Do you think they're going to keep everything affordable for Americans? No. They're going to do what they have to do to squeeze every penny out of America. That's what a lot of large corporations do. They keep hiking prices, making the cost of everything go through the roof. If they're owning most of America, they're going to do the same thing to housing. They're going to do the same thing across the board. The next couple of years, very important to accumulate a property or two properties. Put yourself in a strong position to have options. Wealth is options in 2023. What do you think about this? Drop below, hit the like button, add me on IG. If you want to fix your credit to position yourself, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. Via late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions. Hit the button below, schedule a free strategy session, and love to see how we can help you. See you in the next video.